Hi everyone, new episode of Topical Tuesday. Today we are talking about the recent change in bank interest rates. So the Bank of England reduced their base rate down from 4.75% to 4.5%. So what does that mean for you? What does it mean for the economy? What does it mean for people in the UK and people elsewhere in the world? First and foremost, the bank's base rate is essentially the rate that the banks in that country will lend to each other at. So if the Bank of England is lending to HSBC, they charge them a rate of 4.5% now rather than 4.75%. And that directly flows through to the people in the UK who use UK banks. It's important to note because people hear central bank and they think it's associated with the government. It's important to note that the central bank, i.e. the Bank of England, is not controlled by the government technically. It has something called central bank independence. Now, while it doesn't have any direct government involvement, theoretically, it does have a mandate from the government, which is to keep inflation around 2%. So their bank policy, their interest rates that they set and the things that they do, it has to be bearing in mind that they need to try and achieve a 2% inflation rate. And that is the overarching determining factor for all of their decisions. Now, when I said that it's not directly controlled by the government, the people who decide these interest rates, it's a committee called the Monetary Policy Committee, which is a group of 9 individuals who meet pretty much every 6 weeks or so, and they determine whether they're going to change those base rates. Now, 4 out of the 9 voting individuals are independent experts who are directly appointed by the Chancellor of the Exchequer. So when we say there's no government involvement, strictly speaking, it's not really accurate. There is usually also someone there at these meetings from HM Treasury, i.e. the government, who puts across what the government's objectives are, which should sort of influence the decisions, but they have no voting rights and they're not able to do anything directly which influences the decisions. They're just there to put across the government objectives. So I hope that covers the sort of central bank independence and the Monetary Policy Committee. Now, in the last meeting, which was last week, like I said, they voted to reduce it down from 4.75% to 4.5%. What was quite unique in these meetings of recent times was that 2 of the 9 individuals actually voted for a reduction even further down to 4.25%. Obviously they were outvoted, but it is indicative that there will be more reductions in the coming sort of meetings every 6 weeks or so. So when we say the percentage is basically focused on what the inflation rate is and what it needs to be. Inflation has been well above 2% for a couple of years now, which is why we saw that drastic rise from end of 2023 up until today. Interest rates went up very quickly because inflation rates got into double digits. Now they have dropped off significantly, but they need to make sure that they stay at the lower rates of around 2%. And that's why we're only just getting the interest rate reductions now. But you may be asking, well, what has the interest rate got to do with the inflation rate? Basically, there is an inverse relationship. So as interest rates go up, you expect to see inflation rates come down. So the reason for that is that if interest rates go up, the banks are paying people more to save with them. So it means that people are more enticed to put their money in a fixed term deposit of some sort, getting a higher rate of interest. If they do that, they're not spending it. If they're not spending it, it means there's less demand for products in the general economy, so that the price of them tends to go down, which is directly related to inflation. So if prices are lower, inflation is lower, and that's why higher interest rates leads to lower inflation. On the flip side, another reason why you could say interest rates are directly relative to inflation, inversely, is because if interest rates go down, then it encourages people to borrow because they can borrow now at a lower interest rate. When they borrow, they're going to do one of 2 things. 1 is invest it, 2 is spend it. If they spend it, then again, it means there's more demand for certain consumer products, which pushes their prices up, which increases inflation. Now, you may be thinking, well, surely inflation is a bad thing because it pushes our prices up, the costs of what we're buying. But it's not necessarily the case when it comes to the economy as a whole. The reason there's that 2% inflation target is because inflation also leads to growth in the economy. And again, what I mean by that is when I said there's two things you can do when you borrow money, one is to spend it, the other is to invest it. Well, if you invest it, say, in a business or in property, that business is going to generate activity, generate jobs. The building of that property is going to generate activity, generate jobs, which means the GDP, the amount that the UK produces, increases, and it helps the government with their fiscal policy in terms of what they can borrow, what they can spend, and so on. So typically, you would expect inflation target to be around 2 to 2.5%. And that's what we've been seeing lately. Now, there are other elements and other things to consider when it comes to interest rates, aside from the inflation. One of them is currency. So typically, when you see the Bank of England interest rates go down, you would typically see the cost of that currency go down too. So what I mean by that is, let's assume you have someone in the US who has $100 and they want to invest in a £100 investment, which is currently going to pay them 4.75%. Now, if those interest rates go down, that investment is only going to pay 4.5%. So maybe they're more likely to spend that $100 in buying, say, euros, who is still offering 4.75%. And then we come back to this basic supply and demand activity. So the more supply, the less the price. The more demand, the higher the price. In this instance, there is more demand if interest rates go up for the pound, so it now costs more to buy the pound. If interest rates go down, there's less demand, so it costs less to buy the pound. What that means for you as an individual in the UK is typically if interest rates go down, you are going to get more foreign currency for your pound. So your holidays should become cheaper. The other thing that should become cheaper pretty much immediately when interest rates are reduced, the base rate, the Bank of England base rate is reduced, are variable rate mortgages. So if you're on a tracker mortgage or any sort of variable rate mortgage, variable rate loans, credit cards, anything like that, the cost of the interest on those loans and mortgages and credit cards should have reduced. So it's another thing that is typically beneficial for people in the UK, homeowners, people in debt, etc. Now, one thing to caveat with that when I'm saying mortgage costs should come down, if you're on a fixed rate mortgage, the likelihood is if that fixed rate mortgage is more than 2 years old, you're still probably going to have a higher mortgage expense when you renew. Basically because 2.5 years ago, interest rates were down near zero and they increased very quickly. So anyone that got a fixed rate mortgage, say 2.5 years ago, they got it while interest rates were very low. Now when they come to renew, interest rates are much higher. Even if they drop to 3.5, they're still going to be much higher than they were 2.5 years ago. So the likelihood is your renewal is going to be more and your mortgage is going to be more expensive. So that covers off what the Bank of England rates are, what the base rate is, and how it would typically impact your everyday UK person. Now, another thing to consider, given my profession and what I do, is how does that impact your investment strategy? There's something called reaching for yield behavior. That's essentially when interest rates go down, people can't get the same level of yield at the same level of risk anymore. So because they're not getting as much in return, they're more likely to go for more risky investments to try and achieve that higher yield that they want. This isn't always in line with what that individual should do in terms of their appetite for risk. So working with someone that can help you understand what your appetite for risk is really important. It's also not necessarily in line with your time horizon for investment. Typically higher return investments tend to be more volatile. So maybe they pay you a higher rate of return over, say, a 5-year or a 10-year period when you average it out. But the likelihood is that investment is going to be a little bit more volatile, as in it will go up and it will go down. So you may have a year or two where you've actually made a loss and then 2 years where you make a gain. Whereas with the fixed return type investments, let's say a bank bond, which a lot of people were investing in paying 5-6% at the height of the interest rates, they're probably not going to be available anymore. So it's going to push more people to be invested in variable investments like stocks, ETFs, funds, etc. It's really important that if you are investing in those types of investments, you don't need to access that cash in a short period of time, say 6 months or a year, because there's every chance that the volatility could cause the period of time when you need that money for it to be at a low point and you've made a loss and you have to crystallize that loss and take your money out. So it's important that you match your time horizon for investment with the type of investment that you're in. So don't just go and jump straight into, say, stocks and funds if you've been in fixed term investments, government bonds, bank bonds, corporate bonds, whatever it may be. You need to make sure that it's right for your attitude to risk and your time horizon for investment. Now, another thing when it comes to, say, retirement planning is people may have mapped out a cash forecast and a full financial plan, and you may have a target rate of return on an annualized basis from that. Now, if that target rate of return was 5%, like I said, you could get bank bonds and fixed income, which was paying 5%, so it was achieving your target rate of return. But when it comes to renewal, as these rates reduce, it may be that you can only get 4%. So you have to rebalance what you're invested in and make sure that you're doing everything you can to achieve your target rate of return. So again, understanding what that target rate of return is, having a financial plan and having someone that can guide you along the way is really important. And because of that, this is the time when you should be extracting value from your financial advisor or from your financial professional that is giving you guidance. Right now, they should be speaking to you, either A, making sure you don't make a knee-jerk decision and sell something that you shouldn't or buy something that you shouldn't, and B, making sure they're reassuring you into what is the correct balanced portfolio for you at this point in time for your plans. So my advice is, if you have a financial advisor, reach out to them, book in a meeting and do a review of your portfolio and your planning. If you don't have a financial advisor, then feel free to reach out to me. It is my job after all, and I would love to help you. I hope that has covered everything from an investing perspective. If you did like the video, please do like it, share it, subscribe to the channel, and I will see you next time for the next video. Thank you for watching. Bye-bye.